Hello and welcome to this week's weekly market recap for the week ending Wednesday, May 14th, 2025. Keep in mind that this is a 1 week recap going from last Wednesday's close to this Wednesday's close. So it's a little different. A lot of times weekly recaps done through Friday, but this is a Wednesday to Wednesday close. Just want to make sure because a lot of you will be watching this video on Thursday. So just give you some idea of what I'm talking about here. These charts will be through Wednesday's close. My name is Tom Bowley. I'm the Chief Market Strategist with EarningsBeats.com. Always a pleasure to be with everyone to share my thoughts on what's taking place in the market. And I can tell you this has been another really good week. Dating back to last week, we've seen just another massive move on the NASDAQ, and somebody poked the bear because transportation stocks woke up. They've been lagging for a long time, but transportation stocks were up not far from 10% for the week. And transportation stocks generally only go up for one reason, and it's either because a lot of goods are being shipped or that a lot of goods are expected to be shipped. So there's a very close tie to the economic environment. So anytime we see a big surge in transportation stocks, that has me thinking that the market is expecting economic strength ahead. So that would be really welcome news for the market because we've seen some economic reports of late that haven't been so strong. Speaking of economic reports, we did get the April CPI out yesterday, and it came in better than what we would have expected and what the market was expecting. And with all the talk about tariffs and what impact that would have, really saw nothing in the way of an increase in terms of the CPI. Now, that's at the consumer level. We do still have the PPI, which will be at the producer level, and that comes out tomorrow morning, Thursday morning. That could have a big impact, and that's one reason in the short term why I'm a little bit cautious, even though you all know I've been extremely bullish. I think the market goes to all-time highs. I think we are absolutely trending to the upside, but we're not going to go up every day. We're not going to go up every week. We're going to have pullbacks from time to time. And I do have a few concerns, specifically 4 of them that I'm going to go over during today's show. But again, they're very, very short-term in nature. I don't want to confuse or act like I'm waffling. I believe the market's going higher long-term. That's what I've been saying. I said this was a cyclical bear market, not secular, that we were heading back for all-time highs, and that's exactly what we've been doing. Moving up now over 1,000 points on the S&P 500 in just the last 5 weeks. I'd say that's a pretty healthy advance and certainly more than just a bounce in a bear market. But let's go ahead and take a look at some of the action that we've seen over the course of the last week. There's your transportation stocks leading the way, gaining 1,250 points, which is 9.09% over the last 5 trading days, which swamps everything else that you can see here. And what's interesting is transport's up 9%. And the Dow is at the bottom, up only 2.25%. A lot of times, you look for confirmation. If you think about the Dow theory, talks about the Dow Jones Industrial Average and then transport's moving up to new highs to confirm a high on the Dow. They're not really in sync at this point. You can see transport's really having a remarkable week, actually. NASDAQ up 7.3%. Small cap Russell 2000 up 4.7%. Mid caps 4.7%. S&P 500 4.6%. And then that Dow Jones I just mentioned up just a little more than 2.25%. But green goes with everything. I love to see green, and we saw a bunch of green last week. Moving on to the sectors. This is where it gets me, and this is why I always talk about you have to follow the charts. Forget about CNBC. Forget about these media outlets. They don't know what they're doing. They don't research. They don't go through, get independent research, or a lot of times they don't. They're just throwing stuff out there. It's an entertainment channel. Right now, I'm reading headlines. I'm sure all of you have seen it, talking about stagflation. We're heading for stagflation. Haven't seen this since the 1970s. Anything to scare folks out of their money or to keep them from getting in and enjoying this big rally that we've been in. I want you to look at the sector leaderboard here and tell me why all of the aggressive groups are going up. Look, discretionary 8.5% last week, technology 8.5%, industrials 4.8%, communication services another 3%. Why are these aggressive groups going up so much? And look at what's lagged. Utilities, real estate, consumer staples, healthcare. These are four defensive groups. I can promise you one thing. If Wall Street believed in the whole stagflation theory, these aggressive groups would not be leading the market action. These aggressive groups are leading for a reason. Why? Because the economy is going to strengthen later this year. Why? Because the S&P 500 is going to head up and set a new all-time high. That's why Wall Street is rotating into these aggressive groups. When they rotated into defensive groups back in January, December, January, and into February, I kept talking about, hey, we got problems ahead. We got a lot of rotation taking place. Wall Street's moving into defensive areas. That's when you need to be nervous. And that was when we were at the high. Everything's changed. Once we came down and we had that big drop, especially in early April, all this money has been rotating back into aggressive areas in a big, big way, which tells me ultimately what we're in is a trend that's going to carry us to all-time highs. But I did mention that there are some things that are bothering me, so I want to keep moving on. Let's keep taking a look at these other charts. So whenever I see the S&P 500 go up, I want to see my sustainability ratios go up. And when I talk about sustainability ratios, I'm normally talking about growth versus value, offense versus defense, that sort of thing. You want risk on assets to lead the more defensive areas of the market when the S&P 500 is rising. That gives me a sense that this rally is sustainable, that it can continue. Look at the S&P 500 coming off the bottom, and let's go through these growth versus value ratios real quick. First, QQQ versus the spider. QQQ is more aggressive. You've got higher percentages, higher representation of some of the key aggressive areas of the market, technology, discretionary. You talk about the Mag 7. Those are all featured more heavily in the NASDAQ 100 than in the S&P 500. It's not like the S&P 500 doesn't have growth stocks. It does, but it's going to have more value. There's going to be a little bit more value orientation in the S&P 500. So when you look at the QQQ versus a spider, when you see the market going up, you want the NASDAQ to lead. That's what we're seeing. Discretionary versus staples, one of my favorite ratios. You can see it moving back. And I'll show you a chart in a little while. This, anytime we just show charts of, all of these different ratios and so forth, it's including both the gaps, either up or down at the open, and then all the intraday action. I'm going to strip out the gaps and show you something in a few minutes. But for now, this XLY XLP ratio that I'm showing you is one that includes gaps. So any gap downs that we saw back in April and so forth continue to take the XLY versus XLP down, but that gets ignored in the intraday only ratio, which again, I'll show you in a little bit. The Russell 1000 growth versus Russell 1000 values. This is large cap growth versus large cap value, supporting the S&P, going straight up. Large cap growth index versus large cap value index, almost exactly like the IWF IWD, continuing to go up. Then we look at growth versus value at the mid cap level, going up. And look at the small cap growth versus value, actually breaking to a new 52-week high. So all of these, what I call my sustainability ratios, are going up with price action. This is what you want to see. What you don't want to see is what we had back in December and January when the spider was moving up to new highs and some of these ratios were starting to roll over. That's the concern, is when money is going into the market, we're still seeing the market go higher, but we're seeing rotation away from growth. I mean, look at the IWF IWD. This ratio was dropping like a rock. We topped in December. Market topped in February. Money was coming out of growth. We saw this rotation. That's why I kept saying you got to be careful. I've talked about, I went to 100% cash at the end of January. I was a little early, but I'm pretty darn happy that I was in cash when February and March and April hit. Also talked about when we got to the bottom that once you drop 10, 15, 20%, it probably makes some sense to hold your nose and start buying. And especially once we got into early April, because that's when we saw the manipulation taking place, which I've talked about endlessly for the last 5 weeks or so, maybe 6 weeks. Anyhow, uh, keep going down. You can see every one of these ratios supporting this move back to the upside. So I believe this is going to continue, but we do have some short-term things to worry about. One, you see this vertical, or excuse me, this horizontal green line coming across here on the spider? It's coming across at 555. We had a session last night at EarningsBeats with our members. We do this every Tuesday before the third Friday, 3 days before options expire, monthly options expire. And what we talk about is the point at which market makers would pay out the least amount of call and put premium. So what we've been seeing is the market going straight up. So you got a lot of folks have been buying calls. All these calls, the value of these calls just keep getting higher and higher and higher. And meanwhile, there's no in the money or in the money puts are relatively little because anybody who's been buying puts is just watching the market go up and their puts are losing all their value. So all the value right now is on the call side. It would benefit and behoove market makers in the short term to potentially move prices lower here over the next couple days, maybe even into the early part of next week, so that they pay out less in premiums. And then for those that exercise these options, these call options, it gives market makers some time next week because they're on the other side of the trade to take prices lower potentially next week. I've said it before. I'll remind you, the worst day of every calendar month since 1950 has been the Monday that follows option expiration Friday. That's coming up on Monday. So we got to get through these next couple days. We got to get through the early part of next week. And I think we're ripe for a possible pullback. Now, again, what you do with that, if you're a long-term, investor, it probably is meaningless information. Stick with this trend, which is up. If you're a short-term trader, you have to recognize that the risks are elevated now. And that's what I wanted to basically point out with Max Pain. So that's issue number one. We got Max Pain that could take prices a little bit lower here. Here's the QQQ and where we finished today, and we're, again, showing this horizontal green line. We've got Max Pain down at 470. Now, I don't want anybody thinking I'm calling for the QQQ to drop $50 down to 470 by Friday. I'm not calling that at all. It's kind of like when you get a negative divergence on a momentum oscillator. You don't really say, hey, this is going to go down to this price. It's just a directional clue. It's telling you that, hey, we might be losing momentum. We may be due for a little pause. That's what Max Pain tells me. Now, the actual number where market makers would pay out the least amount would be 470, but they start making a lot more money. Any movement from 518 down towards that 470. If we go down $2 or $3 over the next couple of days on the QQQ, market makers have saved some money. They've made some extra money. If it goes down $10, $20, that, they could make a lot more. And keep in mind, any kind of a pullback to a 20-day test is kind of a normal test. So at some point, if we get this pullback, it just makes sense that 20-day, it could easily be a $25 or $30 drop. And again, I'm not calling for it. I'm just saying we're at risk. It's like meteorologists, when you got a thunderstorm coming in, they say there's a 20% chance of a tornado. They're not telling you that you're going to get a tornado. They're just saying, hey, there's risks. The environment is such that you need to be aware. That's what I'm telling you. The environment, market environment, short term, there's a possible tornado out there. I'm just letting you know. Transports, here's that breakout I just wanted to point out. You can see this is the most significant, most bullish crossover on the PPO that we've seen in transports since all the way back probably in the start of the fourth quarter last year. So we're really starting to get some momentum going in transports. We'll see if it continues going forward, but I do like what we're seeing there. All right, warning number 2. 5-day moving average of the equity-only put-call ratio. A lot of folks getting very, very bullish because the market keeps going up. The 5-day moving average of the equity-only put-call ratio has now dropped down to levels where we see the market routinely reverse. So all these red arrows that I've marked here are essentially once we get down below this 0.55 level. And you can see when we gotten down here before, this didn't really call great top. We went down a little bit and then right back up. But this one, couple weeks we went down. This one right here was a really good top. You get here, another one, we had a top, maybe a week later, but then we had some selling there. Here, you can see back in March, that rally that we had came with that 5-day moving average going back down to 0.55. Recently, I talked about, hey, we were getting close again. We had a little bit of a pullback, and now we've broken out above some key levels. And look at where we're sitting on this 5-day moving average back down at 0.53. So this is definitely an area where in the past we have seen some reversals in the market. So this potentially is telling us be careful. A lot of folks in the options world, and it kind of ties into Max Payne a little bit, but a lot of folks in the options world getting very bullish, thinking the market can't do anything but go up. And what normally happens? The market goes down. So just be careful. That's number two. Here was the XLY XLP where we ignore gaps. Look at this move to the upside here. This is including gaps. So this is what I showed you earlier. This is that move back, and we still got a ways to go to get back to where we were earlier in 2025 at the high in January. But look at this one. This one is much closer to the high. It's actually almost back to where we were in January. This actually topped in December, which, by the way, the intraday gave us a little bit of a clue in December that things were getting a little toppy, because as the S&P kept going up, this intraday, the intraday relationship between discretionary and staples started coming back down. In other words, the rotation was taking place. Wall Street was moving into more defensive areas. They weren't telling us anything about it, but if you follow the chart, you don't need to have them tell you. You can see it. The charts tell us a story. You got to be willing to listen. Anyhow, big move back here over the last couple of months in this ratio, which I think, again, is very bullish for the market and is more of a longer term call, telling me that there's a lot of rotation taking place and that we should expect the S&P 500 to break back to all-time highs. All right, reason number 3, short term, why we could run into some problems. Look at the PPO on the hourly charts. Once we get up to a high and we start to see the hourly PPO roll over, if we try to go back up higher, a lot of times we see failures. This goes back here over the course of the last month or so, and we've probably seen 2 or 3 instances where we've moved up and the PPO has already rolled over. Here we try to move up here, PPO is already rolled over. Here, if we go back up to another high tomorrow, it's going to be with a lower hourly PPO. 1 month chart. This a lot of times will lead to some short-term selling. So warning number 3. I'm going to give you warning number 4 here in just a minute, I think. Let me see oh yeah, I got warning number 4 coming up. But I do want to make sure everybody's aware, at EarningsBeats.com, if you go over to our website, we've got a big event coming up on Saturday, building a winning portfolio, how to do it. First thing you got to do is be able to call the market, because if you can't call the market right, you can put the best stocks in the world in your portfolio. But if the market goes down 20% into a cyclical bear market, you're probably not going to do very well. So we'll talk a little bit on Saturday at 10 a.m. Going to talk a little bit about calling the market, some of the things that I use to call these tops and bottoms. If you've been watching the shows for a while, we've done a really good job at EarningsBeats. I think that we've got some signals that have worked time and time again. I know there are a lot of folks out there say you can't time the market, but those are the same folks who haven't been watching our show, because we've been doing the tops, we've been doing the bottoms, and I'm telling you right now, we're going to all-time highs. If there's one thing I do have, it's conviction. When I see something that doesn't look right to me, I'm going to tell you. I'll get bearish from time to time or cautious, but the majority of the time I'm going to be bullish. Anyhow, come join us on Saturday. We'll walk you through some of the things that we talk about and that I try to teach as far as these different signals, below the surface signals. And then we're going to talk about some individual stocks and so forth and what we look for in trying to outperform the S&P 500, which, by the way, we've done a great job of that with our portfolios over the years as well. But if you go to our website and you click on this link right here, build a winning portfolio, it's going to bring you to this page. All you need to do, put in your name, email address, and submit, and you're set. If you can't attend on Saturday, you got something going, or you just don't want to spend your weekend doing that, that's fine. I completely get it. Well, we're putting it out there for everybody, but if you register, you'll get a copy of the recording. So even if you're not going to be there for the live event, make sure you register so we can get you a copy of the recording. You can listen to it, but make sure you check that out. If you are on a mobile device, you've got a screen up now where you can scan the QR code. It takes you right in, trying to make it as easy as possible for you to register for this and get your copy of the recording, even if again, you can't make it on Saturday, but try to come in on Saturday because I do take questions. So that would be a big reason why you might want to show up. Just a couple more things. So I wanted to mention the semiconductor group because last week I gave I think 13 different industry groups that have been performing well, 12 actually, and then I threw semiconductors in here because semiconductors were just starting to make this turn on a relative basis back to the upside. And what I said was semiconductors, when they move, they move. And so you want to try to catch them early. I talked, I think, specifically about NVIDIA because seasonally it loves the month of May and because earnings are coming up. It loves all of its earnings months, February, May, August, November. But NVIDIA has been leading this charge. A lot of the other semiconductor stocks are following suit. And that is a lot of relative strength. This is relative strength, not absolute. This is how badly the semiconductor index is beating the S&P 500. So really important there. Last thing I want to talk about, and this is possibility number 4 for why the market might struggle. Here is a chart, 50-year chart of the CPI, core CPI. And you come down here, and I've got the 1-month rate of change. So the last quarter or the last month, which just came out on Tuesday morning, that came in at 0.24. The estimate was for 0.3. We came in below expectations. We continue to go lower and lower. Look at the annual rate of core inflation now, 2.78. I mean, how much worse can Fed Chief Powell get this? He said that we're going to have a temporary move back to the upside. I see the annual rate of core inflation continuing to drop without much pause at all. I'm telling you, he's chasing the ghost of inflation. Now, where I do maybe have a little bit of a problem, and as I'm going to go back here, I'm going to show you the chart of the core PPI. Because if you think about it, tariffs are probably, if they are going to hit something, they're probably going to hit the producer at the producer level first, and then potentially get passed on to the consumer. So this is one where I'm thinking that maybe we could get a surprise tomorrow morning. And of course, by the time you're watching this video, you already know. But if we get a surprise and it's higher than expected, which is a possibility because of the tariffs in April, this could spook the market maybe. I mean, anything with inflation seems to spook the market. So I would be, watching this pretty closely. By the way, the core PPI on an annual basis is 2.3% right now. Consumer level is 2.7. The Fed has been talking about needing to see a sustained move since it was 6.7 down to its target of 2. I don't know what it's waiting for. I guess they just want to see 2. Maybe that's the sustained move that they're looking for. Anyhow, I'm not going to get started. I'm done. Just some interesting things I wanted to share with you today. So I really like the market here. I think we go higher in time, but short term, 4 concerns. We got the max pain from options. We got CPCE, the equity only put call ratio, that 5-day moving average getting very complacent, which a lot of times leads to market tops. So be careful with that. Negative divergences. Wasn't just on the S&P, by the way. I could have shown you the NASDAQ. I could have shown you the XLK, technology ETF, XLY, discretionary ETF. All of those are showing negative divergences on the hourly charts. That's number 3. And then number 4, April PPI, Thursday morning. So we'll see what happens. Again, I can't be more confident about the market going higher, that we are in a sustainable move to the upside. But that, again, that doesn't mean we go up every day. Pull back here would not surprise me. Have a great day, everybody. Happy trading.